What is up, YouTube? This is the Working Investor. Today we're going to talk about rolling positions, whether it makes sense, whether it doesn't make sense. It does not always make sense, but there are things to consider when you roll. And there are some psychological stuff that we do, some psychological acrobats that we do to try to, because we hate loss aversion, and we sometimes try to roll positions because of emotion. And if you think about the actual logic behind rolling, you're actually not you're actually closing a position and locking in a loss, and you're opening another position, but you're linking the proceeds of the other position psychologically to the accounting of the previous position. Anyway, so let me give you an example of my account. So here is an example of the TQ. So on 6/28, I put on a 0 day to expiration, which I call a 0.5 day to expiration because my spreadsheet can do the math for 0 day to expiration. And so I put on so the TQs, the triple leverage NASDAQ was trading around $77 and change. So I opened up a cash secure put, $75 cash secure put. It was a 0.22 delta. So my collateral was $7,500 for 100 shares. And I received $27 in premium minus around $1 for the brokerage. So my net profit was about 26, and so this comes out to be a 0.35% return in like less than a day, like a half a day or so, a few hours, whatnot. So if you analyze it, it's 253% return. Of course, I think towards the end of the day, the TQs went down from like 77 where it was trading. I think it went down to like 72, 73 and change roughly. So it blew below my strike price. I could have just rolled or whatever. I didn't. I relaxed. I took a deep breath. I let myself get assigned 100 shares because I'm happy to buy 100 shares at $75 a share. So the following week on Monday, 7/1, I sold a covered call which expires 7/5, so which is around 4 days to expiration. The TQs went up, I think, from 72, 73 and change to 74. But I did sell a $76 cash covered call. I put here CB, which means my cost basis was $75. So I'm selling it for $1 above my cost basis. That means that the TQs blow above $76, I will lose my 100 shares, which I'm okay losing. And I will lose it for $100 total profit because I'm getting $1 per share times 100 shares. And my collateral is $7,500 because that's my cost basis. And I didn't put the delta here because I didn't look at the delta. I didn't care about the delta because when I sell covered calls, I care mostly to sell it at my cost basis or above. I do, and I don't recommend this. If God forbid somebody sells covered call below the cost basis, which I cringe just thinking about it, then sometimes I look very much at the deltas to make sure you're at least a standard deviation, if not more, of the expected move. But I try not to do that kind of stuff. It keeps me up at night. So I try my best to sell at the cost basis, which or higher, so I can sleep well at night. So I received $66 in premium in 4 days, $1 for the brokerage, net profit until, if I don't do anything with the trade, don't manage it at all, which I'm not doing so far, would be $65, which comes out to be almost 1% return in like less than a week. 0.87% return, which is a 79% annualized return if you analyze it. Of course, the TQs boosted up right now to 77, 70, I think somewhere 70, 78, $79 a share or something after hours. I don't care. I'll probably get my shares taken away, and I paid $7,500 to get into the trade. I'll leave with $7,600, plus I'll receive the $65, which I got in premium, plus the $26 in premium. So I'll walk away out of this in this 2-week cycle with $191 from, putting up $7,500. Well, that's why I do the wheel strategy, because I want to, I like doing short term so you don't have to waste too much time and you get max data. But that's my type of strategy. I digress. Let me get back to the strategy here. So there are some reasons why rolling is good and why rolling is not. There's some considerations. So let's talk about short-term capital gains, long-term capital gains. So let's say you own the underlying stock, and the cost basis when you bought XYZ stock was $10 a share. Now it's worth $100 a share. So you made $90 per share. Multiply that by 100 shares, so it's $9,000 that you now have. If you get the shares taken away from you because you sold a covered call, a short call, then you're going to have a tax burden. You're going to be taxed $9,000. Now the question is, hypothetically, let's say you're at the 22% tax bracket, 0.22, 22% tax bracket. And let's say hypothetically you're at the 15%, you're the 15% long-term capital gains tax bracket. So it does. So the question is, are you going to pay 22% on this $9,000, or which is $1,980, or are you going to pay 15% on this $9,000, which is $1,350, which the difference would be $630 saved. So let's say you're 11 months out, like 11 and a half months out, and if you roll it to the next month, even if you roll it to the same exact strike price, not trying to even, for a little bit of a credit, not even trying to roll it up, you could save, and then you get your shares taken away. That means you're going to save $630 in taxes. So that actually would be a net, you increased your profit. $1 saved is $1 earned. So another scenario is, let's say your income went down one year, and in the year that it went down to like nothing, or somebody's retiring, they're not making much money, there's something called, according to irs.gov, there's something called a standard deduction. Standard deduction for 2024, according to irs.gov, is $14,600 if you file single, and $29,200 married file jointly. So let's say you're under the threshold, $9,000, you won't even get taxed. So maybe in those circumstances, if you're not going to be taxed on it regardless, maybe it won't make a difference. Maybe it's better to get the higher tax rate because you won't even have to pay it, hypothetically, speak to your accountant, but then you have your money, you're liquid, you have your money in your pocket, and you can open up a new position that's more lucrative. Also, you may want to increase your P&L because your premium is not everything. There's something called your net lick, your net asset, your liquidation of all your assets. And if you roll up, right, if you roll from $100 to $105 a share, and let's say even you have to pay a little bit of a debit. Let's say you pay $20, $30, $50. You still eventually you get your shares taken away at 105. You just gain $500 more in your P&L, your profit and loss. You got to increase. You have more profit now. So it's a small price to pay, $20, $50 to roll. Hypothetically, and you're going to make $500 more. So those are good reasons to roll. Another, some people look at like cover calls like a boosted return, and they're very married to their stocks, which I don't think one should be married to their stocks, but they never want to lose it. They're like the Warren Buffett type of thing. So they look at premium of selling calls like extra dividends or extra boosted returns, let's say hypothetically 12% return per year. Although some people say 8 to 10% is more realistic for the S&P. But let's say they're looking at it like just a extra dividend, but they are selling cover calls. Again, when you sell cover calls, you should be okay losing it, but for whatever reason, psychologically, it hurts them too much. Again, personal finance is personal, so they want to roll it or something. It makes them feel better. Just to note that when it comes to leap options, I just want to reiterate again. I looked at Investopedia, look at other articles out there. It looks like if you don't own raw stock and you own synthetic stock, you control 100 shares because you sold a deep in the money call option and you're holding it for over a year and a day, you still can enjoy the long-term capital gains if you get it taken away from you after a year and a day. Just to reiterate that, I just wanted to bring out that point. Again, don't trust me. Always verify everything I say. Talk with your accountant. Look it up yourself. But the reason why I don't like to roll is because it's hard to get around it, but when you're rolling, that means the position went against you. A tax loss is a tax loss. And as you see a position going against you, it's probably much easier and more cheaper to get out of the position. Or if you're going to roll or not roll, you should do it before you're in the money. Because once you're in the money, it gets much more expensive. And you have a lot more cash flow when you don't roll. So I try to look at the advantages, like would this extra cash flow quantity be more than the, if I'm talking about a long-term versus short-term capital gains, if the cash flow is way more than the tax burden that I would pay, the difference between the long-term capital gains versus, the standard tax rate that I would have to pay for short-term capital gains, I may not want to, I may not want to roll. But people think that rolling, you can just roll forever and ever and ever. It's not always the case, because as you go further out, when you look at your strike, your expiration dates, as you go, like initially, let's say you look at the triple Qs or the SPY or IWM. You can have daily options every single day. And then all of a sudden you only have it every week. And then you see you only have it like every month. And then you see that you only have it every third month. So there's less volume. And then when you roll, you're going to have to keep rolling further and further out. I'm still stuck in some silly trades that I'm stuck in for another couple of years with the ticker symbol HOOD. And the stock has gone all the different directions and everything. And I regret doing these long rolls. I've been there, done that. You know, it's hard to swallow the pill, but if a position goes against you, just take the loss and and move on. If you're gonna roll, suggestion would be, again, I'm not a financial advisor, but suggestion would be if you would be okay if this wasn't a roll, would you be okay in isolation of putting on this trade? If you're okay putting on this trade in itself because of its own merits, then maybe rolling would make sense, because that's what rolling is. You're taking off a trade and you're putting on a new trade. So you have to get that into your mind, into your mindset. That's what it means, taking off a trade and putting on a new trade. If you're not okay, if you have a losing trade and you're rolling into another losing trade, if you would not be okay with that individually, you may want to take another step back and rethink the whole process. Again, just some food for thought. I just want to open your eyes, get the mind percolating, circulating. Again, speak to who you got to speak to. I hope you guys enjoy. This is The Working Investor, over and out. And keep on making those strives. All the best.